And there we are. It's live stream Tuesday with me, Paul of ATG Digital Media, and welcome to everyone. Today we are going to talk about real estate. Real estate. I'm not going to talk about real estate in general, but in the process of talking about what I think is going to be like a real mind bender opportunity that most people are not going to be thinking about. And I'll talk about real estate, what's going on, and how like the world is like so spun around from how it's been because of innovation and change. And this is a great example of it, which is that you can't just look at things and think like, okay, like this is the way it used to work, and so this is the way it's going to work. No, like there is like so much going on in the world, and it what it does most importantly is that it creates opportunities that you wouldn't really like think about unless you thought through it, and you're like, okay, you connect this dot to this dot to this dot, and you go, oh. All right, but before I do all that, um let's do the legal disclaimer and disclosure here, which is that this live stream and the content from ATG Digital Media is not investment financial advice. It is presented to all of you as opinion, information, engagement, and most importantly, entertainment. All ATG Digital content may contain errors, oversights, or mistakes. Understand that investment operations, what is an investment operation? Buying or selling a stock, crypto, options have significant risk and can lead to the loss of your principal. Next, the owners, employees, contractors own, trade, and transact in the securities that are mentioned in this video, and all content from ATG Digital Media. This is important. We do not take money from companies to promote their stocks or from crypto promoters to recommend their tokens. Next, all the free stuff that we do, the Substack, Ballman Speculating, podcast on Spotify, and YouTube that I'm on right now. Social media, pretty active on X, which used to be called Twitter. I post pictures of my Cybertruck on Instagram. And then Dean is quite active on Facebook in my name. And then sometimes I put up my own stuff. And if you want paid subscriptions, you go to atgdigital.media. Okay. So I have a friend who lives in Austin. He sometimes even shows up on the live stream. So maybe he's on. And so he's been in the real estate business for as long as I've known him. And he's made himself very successful, multimillionaire from buying and selling real estate. Some people call them flippers, whatever you want to call it. But nonetheless, like he's really been all in on real estate. And one of the things that as I was talking to him, through these last 3 or 4 years, I was like, how, would this new world, where you've got these new platforms emerging, right, which are in many ways no different than Amazon or Google or anything like that. They're going after something that is similar to what they do, but what he does, which is that they want to be in the business of buying and selling real estate, except with a digital platform. And so we had this moment in time in 2020, 2021, when Zillow, which is in the silver tier at ATG Digital, they decide they're going to go into business of buying and selling houses. And then they realize like, we kind of like don't know how to do this. They take a large loss, they sell out, and they walk away. But still, the underlying idea that's there that Zillow was going after, when I thought about it, it's like, which is that's a valid idea, which is that in real estate, unlike say the stock market or crypto or the bond market, when you go to sell your house, you obviously list it on the MLS, and then you have a realtor come and show the house, and then you have to wait for the one specific exact buyer to show up that is right for your house with the right price. And so as a result, yeah, houses, obviously in a very hot market like we had in 2020 and 2021, houses, 3 days, 5 days, 7 days, but that's no longer true. I mean, in most parts of the country, there are some parts of the country that are still hot, but in many parts of the United States, for example, where my friend Josh lives, so he's in Austin, it's 90 days, or it's even more. It's 120 days. Contrast that to when you want to go sell a stock, you don't have to wait for the right buyer to show up. You don't have to wait for the right buyer to show up for your, let's say you own 72 shares. I mean, if the stock market worked like the real estate market, you would have to wait for somebody that wanted to buy your 72 shares at the price that you wanted to sell. Instead, there is an intermediary, the market maker, the middle person that's there. Their business is simply be like, hey, we're going to manage the buying and selling of this stock. We will buy from you at this price, and then we will sell it at this price. And that's what sets the bid and the ask. In other words, they're bidding for your stock when you go to sell. And when someone wants to buy, they're like, yeah, this is the asking price. Do you want to pay it? Right. And the truth is that if you go back, to the early days, 1900s, the stock market worked a little bit like the real estate market. You kind of had to wait for the right buyer that wanted to buy your quantity of shares at the price that you wanted. And so a stock deal might take 30 days, might take 40 days, might take 60 days until the right buyer shows up wanting that quantity at the price. And obviously, over 100 years, the stock market evolved, developed where now, a market maker, a liquidity provider says, here's a price, you want liquidity. No one is forcing you to take the price, but if you would like it, you can have it. Here, we'll give you cash, you give this up. And then on the other side, the buyer doesn't have to find the perfect seller with the right amount of shares. Instead, they just go to the middle person. And so as 2020 and 2021 were unfolding, and there was incredible amount of, there's been a real estate, is it wrong to call it mania? I don't know. Real estate frenzy. Maybe frenzy is the right word. Let's go with frenzy. Post-COVID, suddenly everyone like, hey, I want to buy a house. And so, because there were so many people moving and there was work from home and there was obviously, lots of chaos and change and all of this stuff. And in that environment, a number of companies started to, that had been around, but most people couldn't really be like, well, I mean, there's no way that these companies are ever going to be successful. In fact, my friend Josh was like, yeah, I don't think these things can work. And that got me thinking like, well, I mean, I don't think the people who started these companies are stupid. They're not dumb. They aren't foolish. They clearly were looking at an opportunity. Maybe it was a bit early. Maybe the environment wasn't right yet for it. But I was like, wait a second. They're just trying to do what was done already, except in the stock market, in financial markets. They are just simply bringing a liquidity solution using a digital platform to real estate. And it's obviously different than what we currently have. And it obviously represents change. And so obviously anyone that's allied with the old system would be like, yeah, that's not going to work. And I know some of you are in the real estate business and are realtors and will disagree. And hey, that's fine. You can have your view. This is my view, and I want to present it. In my view, it's also an opportunity. And so in 2024, I think now, today, the environment is ripe for this change to happen, Why? Well, number one reason is that we had a price boom in real estate. I think almost the entire country, real estate prices probably on the low side rose by maybe 20, 30% on the low side. On the high side, what, 100%? And then we had the period of time when the Federal Reserve lifted interest rates and mortgage rates went from 2%. I think the high was about 7%. They're whatever, 6 point something percent now, 6.5, 6.7. And as a result, there was a stockpiling of houses. Why? Well, as the Federal Reserve raised interest rates, houses became unaffordable in the way that people price houses, which is what? Which is, well, they're like most people price houses based on their monthly payment, because almost, I'd say, the vast majority of houses, and housing transactions happen through credit, right? So your monthly payment dictates your affordability factor. And so you have, huge increases in housing prices, and then you have a jump in interest rates. Now suddenly a lot of housing purchases become unaffordable, and that starts to lock up the market. And everybody has the same idea, which is that, oh, when interest rates go back down, yeah, prices will be much more affordable, and then liquidity will come back to the market, so we're just going to hold on to our houses. And as you'll see in this chart, existing home sales, right? Let me just lift this chart up. This is a 10-year chart, right? A 10-year chart. Now I can go longer than that, but existing home sales have just utterly, completely crashed. I mean, that's the right word, crashed. I mean, if I were to do this on let's do this even longer. That's all the data on this platform. But that includes, by the way, the 2007 period. You can see existing home sales are where they were almost at the 2008 crisis. And you can see, obviously the bottom came out in 2010 sometime. And that was the low point where the market was kind of frozen for a bit. And then slowly over time, there's been a recovery. So existing home sales have crashed. And what does that mean in practical terms? It means that, well, inventories, meaning like unsold inventories, are going up, particularly in terms of new home sales, right? I mean, this is from an account. This guy, Nick Curley, he runs a app called Reventure app, and he tracks real estate very, very closely. He has a YouTube channel talking about all of this. And you can see that, it's not like 2007 or 2008, being that there are regions of the country where inventory is low. And then there are regions of the country where inventory is very high, like the South and the West. And then, mid-level in the Midwest, and then the Northeast is like, it's average or something like that. But bottom line is that there is pressure building on an overall basis in the housing market, where there are a lot of people that have sort of like inventoried their houses, waiting for either higher prices, lower interest rates, liquidity of some kind, as the economy is weakening, and as even more inventory is sort of building higher. This is from another account that I track, which is single family houses inventories. They're really starting to get up there. This is on a national basis. So even though regionally, I know some of you like, Paul, not in my state, not in my neighborhood, not in my town, and that may all be true. These are national numbers. So, it doesn't necessarily mean that, it applies directly to you, but it does apply directly to any business that operates on a national basis, like the stock that I'm going to tell you about. All right. So that's the setup, if you will, which is that prices of houses have like, a split. This is a guy I read a lot, Wolf Street. He's got a number of charts here that show, you can see the number of new houses, in other words, put up by new home builders. That's starting to, their prices are going to go down. He's got a chart comparing sort of existing homes to new homes. And there's a little bit of a split here where new housing prices are being marked down. Why? Because home builders are not in the business of inventorying houses. They're in the business of selling houses. They've got balance sheets with debt. They need to get rid of houses. So they are willing to cut price earlier than regular home builders, regular homeowners who are, loss averse. In other words, anybody that bought real estate at the highs in 2020, 2021, they're like, well, I can't afford to lose. And so you can see the number of sales from existing home sales, which I put up, have already crashed. In this chart in particular, so this is new single family houses for sale at all stages of construction. In other words, there's even more that are being built. So the inventory continues to rise. Here's more charts showing that just there's a lot of supply coming into the market just about the time that the economy is weakening. And yes, I'm aware that the GDP number for the second quarter was 2.8%. It was better. But I can tell you, and I've been posting this on X, which is that my best indicator for a weakening economy after the Federal Reserve increases interest rates from 30 plus years of being in markets is that the biggest hits to the economy come 12 to 18 months after the last interest rate hike. The last interest rate hike was in July 2023, which is almost exactly 1 year ago. And on command, we are seeing inventories rise in perhaps the most interest rate sensitive purchase that we have as a society, as an economy, which is a home. I mean, in other words, when interest rates go up, the cost of obviously buying a home matters a lot. And then also cars. So we're starting to see inventories pile up in houses, in cars, and we're also starting to see that the 90-day Treasury bill rate, which is something that I track, I'm not going to put this up, but it's starting to roll over. It just made a 52-week low. In other words, short-term interest rates are starting to roll downhill, and there's only one reason why that happens. That's because people are anticipating lower growth and lower rates, and they're trying to lock in, obviously, for 90 days, the highest rate that they can. So all the signs, the forward-looking signs are that the economy is weakening and it's slowing. We're seeing, obviously, a big buildup in housing inventories. And then I'm going to get to the opportunity in a second. While all this is going on, there's also kind of like turmoil in the real estate business, where the government has gone after realtor commissions and passed various rules. They're quite, I don't know, confusing for someone that's like not in the business myself in any way, shape, or form. But essentially, it makes it harder to earn the commissions that realtors and brokers used to own, and puts a lot of obstacles to doing things the way that they used to. So you've got now essentially a sector that is in the midst of enormous, I don't want to say turmoil yet, but change, difficulty, etc. In other words, volumes of existing home sales crashed, prices rolling over, right? The business itself is being restructured because of new regulation, etc., into a weakening economy. And the weakening economy part becomes critical to explaining why the stock that I'm talking about, which is involved in real estate, most people be like, that's a terrible stock to own through this. And I'm going to tell you why it's not. Okay, so I'm not trying to be Mr. Negativity here. the reality is that the economy is weakening. And as that happens, there are various things that'll occur, which is that people start spending less. As people start spending less, companies start to feel the pinch. And one of the places that they will go to cut expenses, cut costs, is they will cut the number of employees that they have. We've already seen this at big tech where they overhired, but we really haven't seen serious economic weakness. But into any serious economic weakness, there's never been a slowdown or recession where employment went up. It always goes down. So now you combine this with huge stockpiled existing homes by regular people, an inventory position of houses that is rising. As unemployment starts to drift upward by whatever amount, there's obviously going to be some financial pressure on some number of folks that be like, hey, I don't want to own this home anymore. I'm unemployed. I've just lost my job. I don't want to take the last of my savings and just, pay my mortgage. I realize I bought too high. I just kind of want out. And whether it be to, take a loss, which some number of people will be willing to do, or go through foreclosure, there is going to be a reaction on price. I mean, this is not some genius on my part. You can go back to 2007. You can go back to any previous cycle on real estate. It's the same pattern again and again and again. But what's different? What is different? Well, the difference is today we have these digital platforms that are aspiring to be intermediaries, aspiring to be market makers, aspiring to be in the middle, where they're like, hey, instead of needing to wait 3 months, 6 months, 9 months, trying to find a buyer at the right price, trying to wait for price discovery. What's price discovery? In other words, what's the clearing price at which this market can become more liquid? Now, in another time, there was no alternative other than time. For example, I bought my very first house in 2010, and I thought I pretty much captured the bottom approximately. But it turns out actually the bottom, if you actually went and looked at it, was in 2011. So we had the peak of real estate prices was late 2006, early 2007. We went through 2007. We have the global financial crisis in 2008. And it takes, on top of that, 2009, 2010, and I believe it was the first quarter of 2011 that we actually see, on a national basis, the price bottom. So nearly 5 years later is where we finally, get like, okay, here's the price at which the inventory begins to clear. Here's the price at which overbuilding, is definitely all gone. 5 years between the top and the bottom. 5 years. That's obviously a long time. And the reason for that is that, number one, human beings, we are loss averse, so we want to take a loss. Second is that, well, if you cannot find the buyer that wants your house in your neighborhood, at that particular time, you can't do anything. The only alternative is obviously foreclosure. In other words, you give up on paying. But what if there was a liquidity provider that says, hey, well, maybe for a 15% loss, whatever it is, not that different than what you experience in the stock and financial markets. Well, what will happen, in my judgment, is this, which is that in this real estate cycle, some number of folks that want out, that can take a loss without financially ruining themselves, that don't want to go through the foreclosure process, don't want to, have that hit on their credit, are going to go to people like these folks. Opendoor. What does Opendoor do? Well, Opendoor is an intermediary. What they are trying to do is essentially what Goldman Sachs, Morgan Stanley, JP Morgan all do in financial markets. Stand in the middle and make a market. And make a market. You want to sell, we will give you what we believe is, the market price. No one's compelling you to take it, but you can take it. And if you want liquidity, you will take it versus waiting what? 1 year, 2 years in a locked up market where, let's say, unemployment is rising, prices are going down, but people are no longer as excited to buy, well, because they can see that the price gains are gone. Obviously, the economy is weakening. So some number of people will be like, you know what? I'll take my 10% loss and go, or 10, 15% loss and go, and they will sell to market maker. As any home gets repriced, it also changes the prices of all the houses around it, right? I mean, prices are set on the margin, which means the last price dictates what the next price is going to be. You see that in the stock market. If somebody is willing to take $100 for a stock that you own and it was $110 the day before, $100 becomes the price until somebody is willing to pay more than $100, and then that becomes the new price. Maybe it's 101, 102. But the same thing applies in real estate. So with this new option, which is that of these companies, Zillow is not in this business anymore, but I imagine that with so many houses out there that need to be sold, they'll probably get back in. But Opendoor is definitely in this business. And this is a stock that, when the growth stocks were all flying higher, this was much, much, much higher. Share this. The $39, $40 stock. So what, about 20 times higher? So this was at its high, almost a $20 billion company. And if I'm right, this brew of what is going on in real estate, which is what? Stockpiled houses by existing homeowners for sale in front of a weakening economy and weakening demand for housing. Then we've got what's going on with the new regulations. And then we've got this new platform, which was not available as an option to people in 2006, 2007, 2008. It means that this cycle will be different. People are expecting that it will look the same as the last cycle. And in my opinion, what's going to be is that because there are platforms like Opendoor, and there's also OfferPad, and there may be others out there, this cycle will turn faster. It will not take 5 years between the top and the bottom, because these folks like Opendoor will attract enough of sellers that they will set the price, and the price discovery will happen much faster. It might not happen in a day or a week, but I would expect that it'll be cut down to, let's say, 2 years. And so what used to take 5 years is going to get shrunk down. But in the process, Opendoor is going to see a boom. Wow. Well, because not only will they see sellers come and say, hey, I'd like the liquidity that you have, but the buyers will also come and say, hey, you've got a house that I was eyeing, and at this new market clearing price, I want to buy in. Now, this is obviously it's an idea that has a level, like a little bit of a twist to it, because we're used to thinking in a straight line process. Like real estate is topping out, and I want something, anything that associated with real estate is going to go down. But it is very much in the nature of this technology-driven, innovation-driven, digital platform, new world-driven world that we live in, that there are companies with technologies pursuing opportunities that have this countercyclical element to them. In other words, because their solution sort of provides a an alternative and a solution to what is going on, they can boom even as one part of the economy sort of like goes downhill and not do well. You can have another part actually benefit because underpinning Opendoor technologies, the real business in the end is really quite simple. It's not that different than Meta or Facebook or Google, which is what? What is Opendoor in the end? Well, they're a very large computer with a lot of capacity to do transactions, and it's a fixed cost. The more volume that goes through this company, at some point, the fixed cost is paid for, and everything will drop down to the bottom line as profit. So they are very sensitive to volume. And where is the highest volume in something like a high ticket item like real estate going to be? Well, I mean, it's clear like, well, at very low interest rates, yeah, we've seen big spikes in volume. But the other place where you'll see big spikes in volume is also when prices go lower and suddenly where even, let's say, interest rates in 2024, which is when I expect interest rates to get cut. Because my experience is that you see the greatest level of weakness about 18 months and out. So that puts us in January of 2025. That's when, anything that I'm saying that, people disagree with, don't like, they'd be like, okay, we can see it now. It's all available. That's when the Federal Reserve will cut because the economy will be very clearly weakening. And it'll be, it'll be obvious that like, okay, we can't keep interest rates at 5.3%. And maybe the new rate is going to be, they'll eventually cut to 2 or 3%. No one really knows exactly. It does depend on how much weakness we have and what sectors get hit. But nonetheless, I would expect in 2025 interest rates to be lower, and Opendoor as a business will certainly see more and more volume because they now become the price setter, the price discovery mechanism for real estate. And that drives obviously customers through their door on both sides. People want to sell to them and people want to buy them. And they're going to experience a boom, which is going to be so weird and so unthought of. And we can tell that this is not priced in. How? Well, because this stock is still essentially trading for nothing relative to its long-term earning potential. I can't think of like a direct peer in real estate that we can think of, but I can think of similar companies that operate on a fixed cost base in the financial business, like the various exchanges, New York Stock Exchange. At my previous hedge fund, we were very large owners of the exchanges, and so we really spent an extraordinary amount of time studying the business of these exchanges. And what they were is these fixed cost platforms. And so volume is the key. Volume is the key. The more volume that goes through, they make more and more money. And it'll, if I'm right, and there's obviously no guarantees, there's obviously risk in every situation. I'm definitely laying out a situation and a scenario that I'm going to say people are going to be skeptical about, and that's fine. Oftentimes, the best opportunities have that shape and color, but Opendoor could absolutely go back to its old high because at this point, no one is thinking what I'm thinking. Very few. I think some are because we are starting to see the first signs. Really, like if I do the 1-year daily chart, you'll see that we've seen this move here from $1.68 to $3, right? So it's a little tiny bit. Someone I think gets this, and they're like, okay, let's go in and build a position. But as volume goes through, and as real estate sort of like whatever it's going to unfold over the next 1 to 3 years, this will go back to its old high. That's what I believe is going to happen. And it's going to really spin people's heads, be like, I don't understand. Like, why is this going up? Real estate is going down. It's kind of like Carvana, right? I mean, people are still flummoxed today as to why Carvana has gone up and it continues to rocket higher. It's going to be the same thing. People are going to be like, that makes no sense. But that's the scenario that is unfolding right now with real estate. And it's bringing this unusual, different opportunity because of what's going on in real estate, what's going on in our economy, and this digital transformation. In other words, pretty much every business is going to be digitally transformed. Real estate has been like particularly digitally untransformed. Everything for the most part goes on pretty much the way it did 20 or 30 years ago, but it often takes like a particularly, a crisis or a problem, a period of difficulty, and that is what sort of like triggers that sudden rapid change. And that movement of the price from $1.60 to 3, that tells me that we're onto something. I mean, I never want to be the only person thinking this, right? We never want to be that early, but we want some people along for company. We want to be like the second or the third person. And that bid up tells me we're onto something. So that's the live stream opportunity of the week. If you like this way of thinking, this way of putting the world together, check into our various subscription tiers at ATG Digital Media, where I do this kind of thing. We start with something either big or something starts small, and we build like a base set, a scenario set, a fact set. And then we like to make sure that the opportunity is not in the stock price. And obviously, when the stock price looks like this, yeah, there's nothing very good that's been priced in. When the stock like looks like this, and you have a nice rosy scenario, a lot of the upside is priced in. If you like that kind of thinking and big money opportunities, check into ATG Digital Media. And we have some questions and comments here, which I will put up as long as they are okay. Rashad, who is a regular live stream viewer, says, "Hey, Paul, always great to hear your take. What do you think about BlackRock's tokenization of real estate? What difference would it make?" It's unclear. It would be an opportunity potentially for one of the platforms that is pursuing real world asset tokenization, but we haven't seen any real anything like this, on any given like significant scale yet. And so we own a token in the diamond tier at AGG Digital called Wrap Centrifuge, which is looks like the leader of real world asset tokenization, but we would need to see a lot more volume. We would need to see somebody really. I mean, it's going to cost money. I mean, you have to put all of these houses on a blockchain, and that's obviously a big data processing event. It's a lot of data that has to go on. You got to pay for the storage on the blockchain. You have to get people to change all of their processes, procedures, maybe even laws would have to change. So it's not something that just can be flipped on a switch. I believe there's more of this going on, truthfully, in Europe with commercial real estate than anything to do with residential real estate so far. Antonio's House of Pizza, another familiar viewer, says, "Hey, Paul, thanks so much for insight and everything you do for the community. Just want to ask if it's possible to do some analysis pre-earnings in Roblox." Well, the thing is, like, we don't really play stuff for earnings. While, I mean, we do some short-term trading in the platinum tier options account, but even there, we're not playing the earnings. The reason why is that it's a coin flip most of the time. I mean, I have no secret source. I have no inside information. Anything that I do is gleaned from some mixture of obviously analysis, of reading what the company says, and then really trying to play off investor behavior. And generally, the most shortest term investor behavior is the easiest thing to be on the other side of. Generally, that kind of information is usually fully discounted. People tend to take positions in things that are very well understood because if you're reading it in the press, certainly every hedge fund knows it. Certainly every major asset management company owns it. So there's very little that you can really bet on based on already known information. So then you're left with illegal information, which I have no interest in getting anywhere near. So the earnings are going to be, I mean, I mean, and just understand the setup that's there. I mean, earnings competition, earnings gaming is driven by Wall Street to create volume, right? It makes you bet. And that's its entire purpose. It doesn't create wealth, it creates price movements. So our stocks are generally, we are looking at the opportunity on a larger time frame than any given quarter. If they beat or disappoint, does it really matter in terms of the like what we are looking to make? No. I think Roblox, if I remember correctly from the last several quarters, has seen solid 20-23% growth. The market has clearly wanted more and the stock has sold down. Will that change in this quarter? I can't really tell. Certainly the stock doesn't tell me one way or the other. Oftentimes, if you see a big rise before quarterly earnings, it means that people are starting to bet on the quarter. And oftentimes, if you don't get something huge, you'll see that. On the flip side, when you see a stock trail down right before earnings, it suggests that people are shorting um, the stock. And so now, even if the number is not that great, you can get a spike up. But these are, very much short-term games. And sometimes I sort of like play with these in my head, and I'm tempted to, but I track these things. And I would say, like, even on a theoretical basis, when I look and see my track record on earnings is at best 50-50, if not worse. Why? Because, I mean, it's you just don't know. I mean, sometimes a company can deliver 3 quarters of above average growth where the stock's ripping higher. And then it turns out that this is a bit of a trap. The company has clearly shifted sales and moved sales to move the stock higher, either to facilitate insider sales or or some transaction that they wanted. Maybe they were looking to buy another company, and so they need to show stock strength and to sort of like meet Wall Street's views. And then in the fourth quarter, yeah, sorry, we can't meet our forecast guidance, and we get smashed. So if you play this game, I can only say, like, track and see, like, are you really getting ahead? Because even at the level at which I track stuff, my hit rate on theoretical spreadsheets that I've kept on, like, hey, can actually this be done with any level of predictability, says, yeah, it's very, very tough to win on any consistent basis. So I don't know if I answered your question. That was a long-winded answer. Rashad says, why'd you choose that color for Elsa? I chose Miami blue. I don't have a picture, but I've been trying to get up something where I can do a live stream from Elsa right around, but it's been either raining on many days, and I'm not quite clear that it would transmit in real time sufficiently. But the answer is that I just thought it was a beautiful color. I saw a YouTube video from California, somebody that did it in that color, and I was like, that color. That looks beautiful. It looks awesome. And in the sunlight, it's absolutely beautiful. And truthfully, even in the rain, it glistens. So hopefully that gives you an answer. Oh, pretty light on questions this week. So I'm going to say today's video, I'll just put up the ticker symbol again, which is that it's Opendoor. And the essence of the idea is this, which is that we have a situation developing in real estate where the solution goes through a new platform that is digital, that can provide the thing that is most needed during periods of, I don't know what the right word is going to be. I don't think it's going to be a crisis. I don't think it's going to be like, a major But clearly, in over-inventoried parts of the country, people are going to want to sell and take lower prices. And normally, to find the person that wants to buy, it would take 3 years, maybe 4 years. But with a platform like Opendoor, you can go get liquidity, get out, move on with your life. So it solves a problem. It can and the scenario and the situation suggests that it will do well. Another question come in here. Steve Dale, who's also a regular, says, been wanting to say you live in North Carolina, check out kiteboarding. It's amazing sport, not as extreme as it seems. I'm 56 and hoping to do it for life. I've seen you mention this, and I've been thinking about, going on vacation to some place where I can try it out. I haven't been to the North Carolina beach in a while, but I have seen folks there, and it looks super rad. So I'm stoked to try it out. RG2 says, hey, Paul, AMD reports today. What are your thoughts? Well, I mean, you can see what the semiconductor stocks are doing. And I have taken the position that I felt truthfully a little dumb and stupid about, which is that we sold most of our semiconductor exposure too early. We sold some of our most well-known positions like ST Microelectronics. We sold close enough to the high where I don't think you'd have too many regrets. Same thing with AMD. Same thing with Rambus. But then we also bought a number of the semiconductor equipment stocks, and there we sold too early, a number of them. We sold in October last year, and there was a AI-driven, in my opinion, hype-driven trade that looks to have topped out. So I don't know what AMD will report, but I will say this. I told you that if I'm right and economic growth is about to weaken, the cyclical stocks are, the cyclical industries are housing, cars, semiconductors. So the semis generally, you might see big numbers, but remember, these trade like cyclical stocks, and the general way is that they seem like incredible businesses at the top when you want to sell, and when the time you want to buy is when they looked almost bankrupt. And so if I look at the charts, I look at these stocks, they're much closer to the top than the bottom. And we bought ST Microelectronics at $5 in 2016. If that was somewhere near the bottom, then this is somewhere near the top. So I'd expect that the results will be good. But if I were to guess, and remember what I said about earnings, my track record is at best 50-50. I'd say, the trend of other stocks of what they're doing is probably what will happen, because the general market trend is more important than any single company's results. Steve Dale says, an amazing help me invest in better my financial life. I will check that out. And that, I think, is it for today. So thank you all for attending this live stream. I'm trying to get this off. There we go. Subscriptions at ATG Digital Media. Thank you all. And come back next week. This is Paul saying